So we are on air. Hello all, my name is Shlomo Cooper, and if I can just have a sound check, please. Can you hear me correctly? Can you hear me good? Or am I muffled? Right, so the sound is good, the sound is good. And by the way, you should see on your screen right now the presentation for today, Insights for Professional Traders, and I'm going to share with you today a couple of insights I actually collected along my career as a trader in Wall Street. So actually, at first glance, these insights may look a little bit basic and elementary, but I can, however, assure you each one of them contains a well amount of wealth and depth. Um, first insight I want to share with you is be willing to lose money on every trade. This is the first rule, my first rule, and not by mistake. How many times have you been shaken out of a play because you've been nervous, afraid to be losing money, only to watch the play soar to incredible amount of profitability without of you? How many times have you allowed a little bit of a wiggle to shake you out of a rocket play? How many winners in your trading life have you owned but you never really let them materialized because of your nervousness, because of your fear to lose a little bit of money? I'm telling you guys that most traders are losing traders not because they can't find what a good play is. Oh no. Most losing traders lose because when they do get those big winners, they don't let them count. You must to let any play to lose you an acceptable amount of money. You must go into any play knowing what acceptable loss is for you. And for one trader it may be $100, for other trader it may be $500, but what is the acceptable loss for you? This is the key thing to success in trading. And in fact, your loss isn't really a loss if it's within the acceptable amount of loss. It's a try, but not a loss. There are acceptable losses and there are unacceptable losses. Every play we make must have an acceptable amount of loss allowed. You must be willing to lose this amount of money on every single play you go into. And believe me, just the basic laws of mathematics will give you your share of winners. Of course, you will also get your share of losers. But you don't want to lose on stocks that actually turn out to be winners, big winners, because this silly fear of losing a little bit of money. You can't be afraid of letting a stock wiggle a little bit as long as wiggles are within your acceptable range of loss. So be willing to lose an acceptable amount of money on every play, and you should know what is your acceptable amount of loss before you enter the position. The acceptable amount of loss will give you on the second step the ability to calculate what is the correct amount of shares you should get into every stock. And my belief is that not all the trades were born equally. All right, each trade is a different play, so we can't actually get into any play with the same amount of share. All right, so we should actually calculate the amount of shares we are getting into every play. Depends on it's depended on our acceptable amount of loss, and for each trader is another amount of loss, is another size of loss. I mean, for a trader that has just begun trading, it may be set for $50, maybe $100. For a savvy trader, for someone that is very very experienced, that is a couple of years in trading, maybe 5 years or 10 years, is much much larger. I can tell you that in day trading, when it comes to day trading, my acceptable amount of loss is set to $300. So actually, I'm willing to risk $300 on every trade I'm taking day trading. Alright, this is the first rule. Let's get to the second rule, and this is really a juicy one. Give a stock at least two chances to reward you. So now, this rule is my golden rule. This one is juicy, and if you take a play and you get stopped out in that acceptable loss we talked about, if you've done nothing wrong, if your loss is simply because you can't win them all, if your loss is by no fault of your own, if your loss is by no making any kind of mistake and it just simply didn't work out, do not walk away from that play. Take your stop, accept your loss, but on the very very next signal, go back into this play. In baseball, you strike out after 3 tries. In the market, stops strike you out if they fail to give you what you want twice in a row. In baseball, you get 3 tries to strike out. In the market, you get 2 chances. If a stock delivers to me 2 losses in a row, then and only then I can move on to something else. But I will not move to another play, I will not move to another stock, I will not move to another opportunity, I will not change the symbol on my screen after only 1 loss. Now, this golden rule here works if you did not make a mistake on your side. If your loss comes because you made a silly error, that's a different story. If you lost because the stock did not do what it meant to do on the very first signal, and this is the rule, move in and even in bigger size. Usually I'm doubling the risk I'm willing to take, and there is a big reason why the second time in is very very important opportunity you don't want to lose. Because if you were right the first time and the stock wasn't quite ready yet to deliver you, the second attempt will tend not to only cover the initial loss you had on the first try, but it would soar much higher than it should have on the first try. Give a stock at least 2 chances to reward you. Now, I'm using this rule extensively both on day trading and on swing trading, and let me just show you how actually it works, and I apply it on any play. See for example here a screenshot of the SPY, the ETF that tracks the S&P 500. This is a 5-minute chart. Now we are starting here the day on this chart with a gap down. This is the end of the day. The stock market start in a gap down. This first movement, as we can see, the market is charging higher, a green bar, another green bar, another green bar, and then when it comes close, very very close to end the to close the gap, then we see a candle, a bearish candle. We call, you can designate it as a bearish shooting star. All right, a shooting star. So usually what we are doing, and there is a thin red line that is drawn here on the chart. Hopefully you can see it. This is my trigger. So I'm telling to myself, once the market is going to trade below the low of the shooting star, this is where I'm going to hit the short button. This is where I want to get short on the S&P 500. Now, of course, on every trade I have also to set my stop, and my stop loss is just set couple of cents above the shooting star. So this candle actually design all my trading plan, all right, because the entry is below the candle, my stop loss is going to be set above, couple of cents above the high of this candle. Now, 1 bar later, another 2 bars later, and I'm out. All right, so this is my acceptable loss. Here it's set for $300. I'm taking my loss and I'm going away, but I'm staying on this chart because it's because if I got out of this trade, it's not because I made a mistake. This was the correct trade. It's just that my timing wasn't perfect, and your timing in trading can't be always perfect. So the same candle that is taking me out of this trade is actually the same candle that gives me the golden opportunity to get into this trade once again. So this is my second chance, and this rule is the second chance. All right, we are talking about, we want to give any trade at least a second chance to give us to give us the opportunity to make money. So the same bar that is getting me out of the trade, another shooting star, apparently it becomes another shooting star, and here is my second trigger. All right, the second thin red line. This is where I'm going to hit my button once again, stop couple of cents above the shooting star, and this is what I planned for. This is why I pressed my short button for the first time. Look how the market is going down here for 30 minutes, and actually if I lost here $300, this play is giving me back more than $1,000. This is exactly why I'm going to risk here more than I was willing to risk on the first trade. So if I risked on the first trade $300, on this one I'm going to risk something about $500 or $600. If your acceptable amount of loss on any trade is $100, on the second chance you want to get with an acceptable amount of loss that is set to $200, twice the amount of risk you were willing to pay for the first time, because the second chance holds a better chance, a better opportunity, a better probability. So this is how you make money on Wall Street. So actually, on in this kind of system, you are actually 50% of the time correct, but because you are doubling the risk, you are actually making a lot of money doing this. Now, let's go. Hopefully this is understood. I'll just give you another example here on OCN 5 minutes chart. And on this day we can see the stock is going up sharply. Actually, we found this chart, this symbol on the top 20. Everyone knew this chart. Everyone were familiar with this stock on that day. And when it got to the lunch, it went a little bit sideways. Look how it lies here on the 20 moving average, and this is my first opportunity. So I like this consolidation, and above this consolidation I'm going into this trade. I'm putting a tight stop below the low range of this consolidation. Now it's actually what's going on here is a dead money, because the stock is doing nothing, it's just going sideways. and couple of minutes, couple of bars, about 10 or 12 bars after that, the stock is going down, and this tail is actually getting me out of this trade, because it goes below my stop, below the low end of this range. Now, the same bar that is throwing me out of this trade is the same bar that gives me the second opportunity, the second chance, the golden rule we are talking about. So I'm going to get into this play another time with a bigger amount of loss, with a bigger amount of risk I'm willing to pay on this dragonfly. All right, this is a very, very bullish candle. So another time, the Japanese candlestick is giving me all the trading plan, because my entry is set 1 cent above the high of this bar, and I'm going to set my stop loss just a couple of cents below the low of this table, below the low of this bar. And look what happened later. This time the price went up sharply, and actually, if this bar is about 6 cents or 10 cents wide, the 10 cents the 10 cents was our risk, and the price went up to 12.76, so it gives us a chance to get something like 60 cents. So actually we risked 10 cents. On the other end, we got an opportunity of 60 cents, that 6 times of the risk. So the risk reward ratio is set to 6 to 1 here. This is a very, very good opportunity, and actually on the second chance we were able to risk twice the amount we risked on the first chance. All right. We are moving to the third insight. Don't be a P&L trader. Don't be a profit and loss trader. And what does this mean? It simply means that you can't make right decisions upon profits and losses. That's wrong. Some traders are up $1,200 in a trade and say, I'm up $1,200, I don't want to lose it, so let me sell here. Let me sell out. That is decision make on the amount of money that the stock has already delivered. Some traders are down $500 on a stock, and that might be an acceptable amount of loss on that stock, but they get nervous and sell, which is against rule number 1, if you recall. Don't let the amount of the dollars you are up or down cause you to make buy actions or sell actions. Your buy and sell actions should be technical in their nature. So don't let the P&L dictate what you do. Let your system dictate what you should do. Let your method dictate what you should do. Let your approach dictate what you should get in and out, not the amount of dollars. So thank you all for listening. Hopefully this is useful information. This is the time for you to type any questions you may have. I will be more than happy to try to answer them under my perspective. And let's see. All right. Tim is asking, some say that 99% of the traders still don't get it. When you are winning, you got to bet more, not less. Tim, I actually didn't really understand what you are meaning by when you are winning, you got to bet more, not less. I understand you refer to rule number 2, the second chance rule, and what I mean by the second chance rule, that you have to bet more after winning trades. No, I'm not telling you have to bet more after winning trades. Absolutely not. Absolutely not. Actually, if I'm having three losses in a row, I'm going to reduce the amount of risk I'm taking into action, because it's just not working, and maybe I'm not seeing something I should see. All right, maybe I'm missing something. But what I'm telling you is that if your trade was the right trade, the correct trade, the best trade to click on the button, and this trade is a trade you should do, implementing your trading approach, trading methodology, trading plan. Then you should try to get into the same trade the second time the stock gives you the opportunity to do so, because our timing in the market can't be perfect, shouldn't be perfect, and one of my it's built into my trading approach that I don't have to be perfect, but my trading approach correct it by implementing this rule of the second chance. But it's only after having a loss, and if it's not a mistake by me, but the stock wasn't ready for me. This is when I'm taking a bigger bet. All right. All right. All right. Shlomo, do you use a calculator to determine your share size appropriate to your acceptable loss? How can this be done quickly? All right, Mike. So this is a great question, and actually I have an Excel that is calculating it. But let's do a very quick calculation. Let's say that my fixed risk on any trade I'm taking, my risk, all right, is going to set to $100. All right, this is the risk. Now let's say I have a stock, for example, that gives me a stop loss in the size of 20 cents. All right, this is the risk that the current trade gives me. So what I'm going to do is to divide the fixed risk, my risk, and this is an amount I know before I'm starting to trade. I'm going to divide it by 20 cents. So $100 dividing by 20 cents gives me 500 shares. So that means that if I'm taking 500 shares on a trade with 20 cents stop, if the stock is going 20 cents against me and I'm stopped out, I'm not going to pay more than $100. Now I built a table that gives you all the calculation: 20 cents, 10 cents, 5 cents, 17 cents, 30 cents, all the possibility of risks, and then it actually fits the correct amount of shares. So actually what I'm doing and what my traders are doing, they have this printed table in front of them, and then on the spot, on a mini, in a matter of a blink of an eye, they can actually know how many shares should they risk, how many shares should they take into a trade. But we are going to develop it, and I'm going to elaborate it on one of our following webinars, how exactly to calculate the amount of shares to take on every trade, and I'm going to share with you my calculator, my Excel. Zero is asking, what stop loss do you use, limit or market stop loss? So actually, Zero, I'm not a fan of the market stop, because if you went to buy a car, all right, from a dealer, you wouldn't tell him, all right, I want this Mazda, I want this Toyota, and he is asking you, all right, how much money would you like to pay? And you say, and you won't answer him on that question, all right, I'm going to take it on any price you want, all right? Absolutely not. You are going to negotiate it, and this is exactly what you are going to do in the market. You are not going to let the market makers gives you the the price they want. You want to dictate what price you want. So this is why I'm losing limit orders. But I'm calling it, when it comes to a stop loss, I want also to ensure I'm going to get out, because I don't want to hold the stock if suddenly the stock is going down sharply. So I'm using what I call generous stop loss, generous limit stop loss. And what I mean by generous is that if my stop set to 66.99, this is where I want to get out of a stock, I'm going to put my limit at 66.90 to ensure I'm out. So just be generous on your limits, but give always a limit orders. Actually, I'm not giving my traders in the advanced course I'm teaching an opportunity, an option to use market orders, only limit orders. All right. Tim is writing us, Shlomo, I have also made a same Excel spreadsheet, but most of the times you get share quantities that are not round numbers. All right, Tim, yes. So usually you don't get round numbers. By the way, considering the way that ECNs on Wall Street are working, we want to use round numbers because ECNs prefer round numbers. So what I'm doing is just to round to the closest to the closer number, to the closest number. So that means that if the amount of share you should take is 387 shares, you are just going to round it up to 400 shares, and that is a done deal. All right, yeah. So you are either round up or round down. All right, guys. It was a pleasure to be with you. Of course, we are going to upload this webinar to YouTube, and I'm going to see you all in our next webinar next week on Thursday. If you have any question or if you have any suggestion for something you would like to hear in these webinars, don't hesitate to write me at shlomo@tradenet.com. Thank you very much, guys, for being with me, and hopefully you are going to have a great trading day. Bye bye.